Okay, stand by. Hey folks, welcome to Wednesday, the 4th of May 2022, and really happy to have April behind us as we face into the summer. But of course, we have headwinds in these equity markets at the moment. Tonight, we have the FOMC statement and interest rate decision. We are pegged to now be raising rates. Well, the Fed is to be raising rates at a clip of 50 basis points, both in the May, June, and July meetings. And so, the markets have been really kind of pricing in a lot of this hawkishness, as we've all seen now over the last kind of 10 trading days. And so we are kind of under a bit of weight on equities at this time. One thing that's really ripping this morning and doing very well here is oil. We are up about almost 4% here, trading 106.39s on WTI. So a lot of market commentators really commenting that it's a very difficult time to be looking to buy at the moment. Of course, there is always one man buying when everyone else is selling, and that's Warren Buffett, who has gone on a buying spree at the moment, and so well should he. But Paul Tudor Jones, for example, really favoring being in cash at the moment, not really seeing the dip buying opportunity as we face into another three rate hike cycles, or well, really the start of these rate hike cycles of 50 basis points to come. So I think further downside in stocks. One thing to note is while we come into this hawkishness period for the next four meetings, really, actually, I know it'll be three for the 50 basis point hikes, but then we're going to get into 75 basis point hikes. We're looking at maybe two of those before the end of the year. Backloaded there. I know other people are talking about the Fed front loading their cycle, but I think there will be a 75 basis point hike in this year towards the end of the year, unless they come out with it this evening. Now, of course, we're going to be covering this live in the Discord room tonight at 7 o'clock. So we'll be on about 6:45 p.m. To lead up to the event. We'll go live on YouTube for that event at the time, and so if you're watching this on YouTube, this will be after the fact. So we would have, it'll be 7 a.m. in the morning when you're watching this tomorrow on YouTube. So look, let's get over to the charts, but keep in mind that equities are under the pressure of a hawkish Fed here, and the dip buying is not really showing itself too much. I mean, yeah, we've seen some downside here, but look, let's get over and look at these charts here. So you can see right away, I'm looking at the Nasdaq on the daily bars. Center left of screen is the 60 minutes. Look, I mean, yesterday, if I zoom in on the 60 minutes here, look, I mean, this trade here yesterday looks absolutely horrible. Basically horrible. I mean, you got basically on the day you had about 1.6% range on the day. It's about $215. That's quite a horrible day to be trading. We traded the range one. Well, actually, since the European start, one, two, three, four, five times we traded that range, give or take. 1.5% there, or sorry, it was 1.5%. So it was a range of 1.6%. So for me, I definitely huddle behind what Paul Tudor Jones is saying, and just stay in cash. This isn't the time to be buying the dip at the moment. There will be clearer and cleaner opportunities to come, and really let's see how the Fed go tonight. Just in mapping out where we are here, generally we can go back to the daily bars, and you can see that we've traded from the bottom of this range here, back up to the 100 100 crossover, so the 100 crossing down below the 200. And of course, that time old selling coming in on a cross like that, and down we come. So I think those traders are really getting paid out right now for those shorts. And then buyers, a lot of that confusion in the market yesterday. Basically, buyers battling sellers on the bottom of this range. For me, I think technically, if we do retest the bottom of this range, you can see what's happened every time. We've just flushed out on the bottom. I actually need to maybe upgrade my analysis on this, but it's kind of finding newer areas. In fact, this range may actually extend to back down to here, which makes a bit more sense, and that is the low of the 1st of February 2021. And of course, then we're actually really seeing bit more buying that makes sense down there, and that seems to be the range bottom that seems to be bought at the moment. So let's keep an eye on this new range low. I think a drop out of here, there'll be a slight amount of support on that 12,593's half. But I'd like to wait a day or two. Well, I think the trading for the short side to be done here is a long way off, if at all. We had a lot of excess on this day here on Monday of this week. Put in on the downside and just bought back up. And then yesterday, of course, a lot of confusion about the continuation of that rally from the bottom. So, yeah, I think if we retest 12,939s, I'd like to see the buyers come in and start to drive and then look for longs on pullbacks there to get back up in this range. So, that's a nice update to the range analysis on the NASDAQ. I think on the SPOOs, on the daily here, let's have a look at the range. I'm staying with the range that I have here, but you can see that we have dropped out. We have looked for lower pricing going back to as far as May, a year ago, basically almost a year ago here, 20th of May, 19th of May last year. We've kind of tested those areas and found the buyers so far in the SPOOs, but it seems like it's got quite a bit of headwinds, really, as we may push up here, back to the 20 EMA. I'd like to see if there's selling to be done there and a retest on the 20 EMA, certainly on the trend that we have here and the bottom of the range. So it's not a fantastic time to be kind of looking for a clear market direction, but, generally, I think, yeah, the buying that came in on Monday this week, Ireland and England were on bank holidays. I think, driving up yesterday. Let's have a look at yesterday on this thing. Yeah, yesterday, really, we kind of wiped that range probably well. Actually, well supported in the European lows, then driving up and then wiped the range back, probably pretty much 2/3 back there at 6:30, closing obviously higher. So, looking at the Monday buying that came in here, we could probably see where that came in if we look back in time here. That was, not so obvious there. I'm still holding out for this gap to close. 39.96 evens on the top and 39.76 is even on the bottom. And once we fill that gap, then we could think about, maybe getting our, pulling out of the nosedive here that equities are in. Let's just minimize this and look at the Dow. I mean, the Dow is holding relatively well, on this trend. You can see here that trend put in from the low of the 24th of Feb this year on the 8th of May this year, March this year. That trend breached on Monday, finding lots of buyers, and now we're 2 green days so far pre-US session, two green candles here. Is this the buying coming in to drive us back up? I don't like to see the breaching of this trend, to be honest, on the lows, but that may be all we get. But you have to basically come back to, okay, hold on a second. Why would we be selling down more? Well, there's a lot of buyers not stepping in and protecting these lows. That's what's being said. However, a hawkish Fed, you could say, well, they're raising rates this evening by at least 50 basis points, possibly 75 basis points. That should push equities down, but you got to slow down there and remember that the market has priced that in. The market has at least priced in a 50 basis point hike from the Fed this evening. and over the next two meetings, June and July. All right. So, you can't be using that as your fundamental catalyst to see more downside in equities because it's priced in. All right. It's priced in. So, are we looking at the big question is, are we looking at the exhaustion of the sellers here on Monday? They've been smacked down, and then we're just going to rally now back up and into this upper range around 3,400s or 34,000s on the Dow. I'd like to say yes. I'd like to say yes. But look, it's I'm not here to tell the future. I'm just here to map out these markets and see where we are relative to where we've been. Right. All right. Let's look at oil. Actually, before we do that, let's look at the dollar. Okay. So we were looking at the dollar there last week, potentially topping out on the 103 spot 82s. Now that would be all too lovely, and that is, of course, the high of the week of the 2nd of January 2017, where we're kind of almost double tapping highs here on the Dixie trend. So, if we zoom in here, I think for whatever reasons, and there are multiple reasons for it, I think the dollar is strong. Obviously, the situation in Ukraine, we're facing into a more hawkish Fed. A lot of that is getting priced in across the equities markets. But is there generally, that flight to cash, the Paul Tudor Jones note to really maybe favor going to cash? It's not a great time to be picking stocks. And you're seeing that going into the dollar. You're not going to be going into the bat or the Israeli shekel or the Turkish lira, as a safe haven asset or a currency. It's going to be the dollar. It's going to be the euro. It's going to be the Swiss franc. And the dollar is, the only globally traded currency. So, here we are on highs on the dollar. Do I think there's more of a push in here? I think we could breach these recent highs. How much continuation forward? Well, I don't know. And when we get into wide open blue water like this on a product, I like to get out the Fibonacci extension tool. Take the recent swing low to maybe swing high and a pullback. That is a very shallow high, but the pullback here would kind of chart us. Now this is a big weekly chart that would chart us for 400% Fibonacci increase from the lows that we were in late the 2020. I don't know about that pricing, but I think we could certainly peep our head into higher value somewhat on the dollar and blow out the lows on the euro. It's just, we have this big morning trend here on the euro, and you can see we're kind of in the middle of nowhere now, going all the way back. I won't bore you too much with this, but going all the way back to, where are we here? We're going back to 2000. And last time we were down at the 06 560s was 2002. Now the next support to come in is the low of 2000, 1st of May 2000, and that is one spot 03 175s. And if I kind of go back forward to where we are now, it's just really hard to see the euro pulling pulling up the reins here, and then just making a massive recovery back up from here. But saying that, looking at the fundamental picture, the ECB is signaling for rates to be rising in July, and that really is not that far off now. So, can the euro start to find, a little bit of that, flight to cash, an appreciation in the face of the rate hike cycle, which it will have. It's just, when, the big question with all trades is, timing. Analysis is a dime a dozen. Good analysis is a dime a dozen, but the timing of putting that into practice is the rarity, right? So, is this the time? I think it's either now or else we get down, have a really bad couple of weeks on the euro, bottom out on the lows 03 175s, and then pick up the reins and we kind of get way back up over the preceding kind of 6 months to a year after that. So big stuff we're looking at on the euro. Is it time? I currently am long the euro, trying it out from here. I'm going to be stopping out on this thing if we breach pretty much the lows of probably the lows of this week so far. So, and you're seeing the dollar behaving quite well actually so far. And all right, to finish off, we look at oil. So WTI on on the charts. I'm just looking at Bloomberg here. They've got they were marking Brent crude is down 3.4%, while WTI is up 3.5. So it's quite an interesting divergence here of the grades of oil. So we're not going to dwell on that too much. We're just here to look at WTI right now. And we are up 3.6% on the day so far, 106.09s on the market at the moment. Generally, this trend on the daily bars we're kind of breaking out of. We're generally broken out here. Retested that trend break on the 25th of March, April, 25th of April, and up we go. So it's been very aggressive buying so far on the book this morning on oil. And I think just a little bit of a pullback will be in order. But generally, I think targets on the upside is 108.28, and I think this time it's for real. I think we've flushed out a lot of into very dizzy high prices after the invasion of Ukraine, of course, and then we've pulled back quite a decent amount. We've had SPR releases, all that stuff, IEA coordinated SPR releases. Almost 2 million barrels a day put back onto supply to ease the supply constraints, of course, brought around by the Russian invasion of Ukraine. However, we're now at a situation where we've lost about 3 million barrels a day from Russia going offline, and having embargoes and all this sort of stuff. Well, we don't actually have the embargoes yet, but it's just a lot of international buyers turning away from Russian oil. A lot of looking at Vitol and these main buyers is because they simply don't believe that they can take or get delivery. If they pay for the stuff, they're not going to get delivery. That's by the by. We're missing 3 million barrels out of Russia, so that's really negating the IEA release. And what else you're looking at is you're getting offline of production assets in a couple of different places. Libya, Kazakhstan is now down to about 800,000 barrels. Don't quote me on that. So that's how tight the picture is. Historically big SPR releases, coordinated SPR releases, and Russia, just negates the whole thing. So we're really treading water on oil. And the reality of this is, and I've talked about it at length, is that it's not enough. The market's way too tight. They need another 3 million barrels. And guess what? If the US was to do another release of the same amount, they would have zero, that is right, 0 barrels left in the SPR. All right. They cannot do another release of this magnitude because they don't have it. Okay. So this is how perilous this is for the US. All right. Now, and for the global energy picture. So, I don't care what you say, Russian invasion, blah, blah, blah. The inflation that we're in now has been energy push inflation, and it's been for about 3 to 6 months before Russia invaded Ukraine. I did a video on that for quite a while ago. Energy push inflation, it's real. And so this Ukrainian invasion obviously has just exacerbated that situation and put it on steroids. So, I think we're going to be trading 123s and we're going to be trading 134s before not too long on WTI. I think it's quite strange this morning that Brent is down the same amount that WTI is up. So I think that's really, really interesting. All right. I'm going to stop rabbiting on there. Gold, I don't see the trade. I'm not going to get into that at the moment. So listen, I'll stop there, and we'll just put the camera back up. And listen, have a good session. I'll see you live this evening. Well, actually, you're watching this in the morning, so you would have seen it last night. Going to have the Fed decision. It's going to be a lot of volatility tonight. And I think we've got a good remainder of the week in store for us. So I think the best trading is actually going to be Friday. And let's see what we get. All right, take care. Talk to you soon.